Well, the one big beautiful bill, first of all, it affects everybody. So to put it in perspective, in 1986, then President Ronald Reagan and Speaker of the House Tip O'Neill, they were able to come up with the tax structure that went from 1986 until 2017. In 2017, there was a temporary, if you will, people call them the Trump tax cuts and have all sorts of other names for them. Regardless, that all became memorialized and codified with no ending in place, much as what they did in 1986. So now for Colorado business owners, what that means is that we have a tax code that they can count on. It took them 30 plus years to change the last law. I'm pretty sure it's going to take them a long time again, because let's face it, Congress would have to agree. Without consideration of whether that's a possibility or not, let's just assume it's going to take them equally as long to move forward. So if you're a business owner, you now understand what it looks like to do investing in your business, to do investing in land, to depreciate equipment, to what does the payroll structure look like? What is the taxation? How can I most effectively work with my CPA in order to understand what programs are available and how that impacts my bottom line as a business owner. What it did for everybody is it gave, whether you like it or not, is immaterial. It gave a basis by which you have a reasonable expectation of the longevity of a tax code. And in doing so, certainly they'll have some tweaks in the future. Really can't tell you exactly what that would be, but I can tell you that tax codes are slow to change, and stability is something that business owners presumably can count on as it relates to that. There really hasn't, from an individual perspective, there really hasn't been too many questions regarding, what does this mean for me, except for conversations regarding Roth conversions and whether we can convert within our existing 403B to or our 401k. Can we convert some of those funds? Can we convert SEP funds? So on an individual basis, it really, let's face it, the Treasury wants the money. They've given investors the opportunity to satisfy their goals, which is hopefully in the future, after 5 years, having tax-free income from their investments. And for that, yes, you have to pay the Treasury up front. So there are a number of strategies that we use in order to not bump brackets, if you will. So let's say you're at a 22% bracket, tax bracket. And the next tax bracket is 24%. So the incremental revenue or income above that 22% number goes to 24. Well, that's a 2% differential, not a big deal for most people. But to go from 24 to 34 is a huge jump. And so by not bumping brackets, we just don't want to bump above that 22 or 24 with where you are today. Why pay extra when we can simply time when we do the conversion? It makes a lot of sense, and it's why we do long-term planning, is in order to say, okay, so what does this look like? And what is the break-even period, reasonably speaking, to where your investment account, IRA, SEP, 401, 403B, after paying taxes, now you're in a Roth structure, what does that look like? Or what does that incremental change every year look like in a break-even period? And of course, that's all subject to market volatility and returns on investment. Nobody can tell you what the future is. But I can tell you that if you look at the long-term trend of the market, it's generally upward. And the further back you pull from that in terms of a time frame, the more upward it looks and the less bumpy it looks. So the question is, can you focus on the long term? And if the long term is defined as 5 years or longer, well then in 5 years, if you do a Roth conversion in 2025 to make it real, in 2030, if you're of an age where you could start taking proceeds and would want to, you can actually take those proceeds, any gains, etc., on a tax-free basis. And certainly since you've already paid on the principal amount, there are no taxes for that to come out. Obviously, notwithstanding the 59.5 and other regulations, etc. But generally speaking, that's why it becomes very attractive. So the one big beautiful bill for business owners, what I've heard is the primary benefit to the business owners would be in the depreciation and how they capitalize equipment. Now, obviously, they're working with their CPAs and such, and their CFOs on how that affects their individual balance sheets. But when you start looking at depletion allowances and depreciation allowances and what that means for E&P companies, exploration and production companies with natural resources, or what that looks like from a capital plant and equipment, buying new equipment, do I lease new equipment? They're working with their financial advisors and their CPAs and their CFOs in order to create a more holistic picture, which is geared for, frankly, the certainty of uncertainty, but understanding that some of that certainty just landed in their lap in terms of accelerated depreciation.